Analyze the barcode from Overcome Mortgages. So we're going to take a look at the 30% mortgage rule. So when it comes to buying a home, this is one of the simplest and most powerful strategies. So as a mortgage broker, I know all about it. So let's get into it. So the rule itself is simple. You keep your monthly mortgage payment at no more than 30% of your total monthly income. So for example, on a £100,000 salary, that would mean a mortgage payment of up to £2,500 a month. So I don't just see this as a number, I see it as a strategy that protects your finances, improves your chances of mortgage approval, and sets you up for long-term success in the housing market. So why is that? So it allows you to protect your home and family. So by capping your mortgage at 30% of your income, you leave room in your budget for essential protection. So that means life insurance and critical illness cover to safeguard your family's future. It means income protection to keep payments covered if you can't work. And if the worst happens, you'll have the financial resilience to keep your home. It also keeps you looking at property within your budget. So the 30% rule acts as a built-in filter when house hunting. You avoid falling in love with homes that would stretch you too thin. You focus on properties you can comfortably afford, reducing the risk of financial stress later. And you can still enjoy life outside your mortgage, so things like holidays, hobbies, and family time don't have to disappear. You also improve your chances of passing lender affordability checks. So lenders assess whether you can afford repayments now and sometimes raise roads in the future. If your mortgage is within 30% of your income, you're more likely to pass affordability stress tests. You'll have a buffer if interest rates increase, and you present yourself as a lower risk borrower. It also gives you a healthy level of exposure to the housing market. So a mortgage at up to 30% of your income is big enough to build equity over time. It lets you benefit from potential property price growth, and it helps you avoid over leveraging, which can be risky if the market dips. So it's kind of the sweet spot between participating in the market and protecting your financial stability. Also, another key point is it leaves room for savings and investments. So with only 30% of your income going to the mortgage, you can build an emergency fund for unexpected costs if you didn't already have one. You can invest in pensions, ISAs, or other assets for long-term growth. And you're not forced to choose between paying the mortgage and saving for the future. So this is your real wealth builder that allows savings to remain a priority. You can also reduce stress and increase flexibility. So lower housing costs mean you can handle income changes, like starting a family or changing careers. You have more flexibility to overpay your mortgage if you want to become debt-free sooner. You're less likely to feel house poor when most of your money is tied up in your home. So in terms of some of the key takeaways, the 30% mortgage rule protects your ability to safeguard your home, family. It keeps your property search self-realistic and affordable. It improves your chances of passing lender affordability checks, and it gives you healthy exposure to the housing market without overstretching yourself, while leaving room for savings, investments, and lifestyle spending. It also reduces financial stress while increasing flexibility. So that's the 30% mortgage rule overcome.